Hello everyone, Mr. Lipchick here, and our topic for discussion is the bond market. Bonds and other assets. Bonds are defined as loans representing debt that the government or corporation must repay to an investor. They are generally low-risk investments, purchased at a fixed rate of interest, with a rate of return generally lower than that of other investments. In the past, they have taken the form of paper certificates, but are now often issued electronically. Bonds have three basic components. The coupon rate, which is defined as the interest rate that the bond issuer will pay to the bondholder. Maturity, which is the time at which the payment to the bondholder is due. And par value, which is the amount an investor pays to purchase a bond and what will be repaid to the investor at maturity. The yield is defined as the annual rate of return on a bond if the bond were held to maturity. Retiring the debt is when the bond has reached maturity, the issuer will retire the debt by paying the holder its par value. In addition to earning interest on bonds, investors can buy bonds at a discount from the par. Investors who need liquidity will often sell bonds at a discount, especially if interest rates have risen above the interest rate of their bond. Bonds are also rated according to the likelihood that the principal will be paid at maturity, and if interest rates are being met. Interest rate payments, that is, are being met. Standard & Poor's and Moody's are the most commonly used rating systems. The highest S&P rating for a bond is AAA, and the lowest is D. Higher bond ratings will lead to higher prices at which the bond will sell. Low-rated bonds must offer higher interest rates to attract buyers by making up for the higher risk. Advantages and disadvantages for bond issuers. Once sold, the coupon rate for the bond will not increase or decrease. Bondholders are not stockholders, and companies do not have to share profits with them. Companies must make fixed interest payments even in bad years. So where a company can decide whether or not to issue dividends, the bonds don't have that. They have to pay the interest whether or not the company's doing well. Bonds can lose their ratings if a company has financial problems, making them harder to sell. Savings bonds. There are low denomination bonds issued by the U.S. government, such as EE bonds, which are now issued only electronically. Because they are issued by the government, there is almost no risk. In the past, they were sold at less than par value, but since the writing of this textbook, they are now sold at face value. They are issued to help the government pay for public projects such as road building. Treasury bonds, T-bills, and T-notes are government investments with different lengths of maturity. The longer to mature, for a higher yield. Municipal bonds, or munis, are issued by municipal governments such as cities and towns. They're considered safe as governments have the power to tax. They are rated by S&P and Moody's based on the financial health of the town. Corporate bonds are bonds that a corporation issues to raise money and expand its business. They are issued in large denominations. Because corporations cannot tax, there is a moderate level of risk. Closely monitored by S&P, Moody's, and the Securities Exchange Commission, the risk can be monitored. The Securities and Exchange Commission, or SEC, is an independent government agency that regulates financial markets and investment companies. A junk bond is defined as a lower-rated, potentially higher-paying bond. High yields, but a much higher risk of issuer upon default. They have a much higher risk of issuer default. The purchase of junk bonds contributed to the S&L scandal of the 1980s. These bonds were purchased, they didn't work out. That, plus a number of other things, caused those institutions to fail. Other financial assets: certificates of deposit, or CDs. This is a common form of investment issued by banks to small investors for fixed amounts of time. Money market mutual funds. This is a type of mutual fund in which intermediaries buy short-term financial assets for higher interest rates, and they are not covered by FDIC insurance, making them riskier than savings accounts. Financial asset markets. Financial asset markets can be classified into capital markets and money markets. Capital markets are markets in which money is lent for periods longer than a year, and money markets is a market in which money is lent for periods of less than a year. Assets can also be classified as primary markets and secondary markets. Primary market is a market for selling financial assets that can only be redeemed by the original holder. Savings bonds would be an example. Secondary market is a market for reselling financial assets. That concludes our discussion of the bond market and other financial assets. Thank you for viewing, and I look forward to seeing you in the live lesson. Have a great day.